Here's a chart where the price continues to decline, forming lower lows. Let's break this down in detail, but before we proceed, if you find this content valuable, hit that like button, and if you're new to the channel, make sure to subscribe and enable notifications so you won't miss any of our upcoming videos. I'll catch you right after the intro and disclaimer. After a certain point, the price struggles to break below its previous low and starts to reverse, forming a strong green bullish candle. From the price action perspective, a double bottom pattern develops beneath the chart, establishing a support zone. This candle also breaks upward through the trend line. Considering these two signals, many retail traders view this as a reversal setup and take long entries, believing it's an ideal price action trade. However, soon after, the price drops sharply, hitting all stop losses before making a strong upward move. Traders who relied solely on price action end up trapped in this scenario. If you had combined the smart money concept with price action on this same chart, you could have avoided getting caught in the trap. The market continues forming lower highs, showing that sellers are consistently pushing prices downward, maintaining a bearish structure. This leads many retail traders to look for long setups instead of short opportunities. As a result, several retail sellers have placed their stop losses above, creating liquidity in that area. Over time, as retail interest on the sell side begins to fade, the price fails to breach its recent swing low. Many traders then assume it's a support zone and enter long positions near the double bottom. But as explained in the smart money concept, the market tends to make major moves toward areas with the most liquidity. Before those large moves occur, big players target retail stop losses to clear them out. So, before the price rises, it first sweeps the stop losses of retail buyers around the support area, collecting that liquidity, and then rallies upward, grabbing the liquidity above, alongside price action and smart money. If you need added confirmation for an entry, you can use the Relative Strength Index, RSI, on the chart. Notice how the price keeps declining while the RSI shows a different movement. This is known as RSI divergence. Since a bullish divergence has appeared on the chart, it signals a higher probability of a bullish reversal. Therefore, it's wise to avoid short entries in this area. How do you enter a trade by analyzing a chart? Let's explore how you can combine the smart money concept with price action. In price action, we study charts to understand what retail traders might be thinking and where they are likely to enter trades. For this purpose, we use candlestick formations and chart patterns. Because these tools are simple to interpret, most retail traders depend entirely on them to execute trades, and as a result, many suffer losses. This is one of the main reasons why over 90% of retail traders end up losing money in options trading. On the other hand, the smart money approach focuses on identifying the exact chart levels where large institutional players or market operators might trap retail traders. To find these levels, we analyze the zones on the chart where retail participants have built up the most liquidity. Since the smart money concept can be a bit complex, only a small fraction of retail traders actually study and apply it, and that's why very few achieve consistent profits. However, if you already understand price action, learning smart money becomes much easier, allowing you to plan your trade entries more effectively. The key is to observe the chart closely and think from the perspective of an institutional trader. Let's go through an example to make this clear. Here, we're looking at a 5-minute time frame chart, where the market is positioned near 51,100. After opening around the 5,100 level, the price moved rapidly upward, breaking above 5,300 with a strong bullish candle. Observing this breakout, many retail traders rushed to enter long positions. However, soon after, the price declined sharply, triggering their stop losses and forcing them out of the market. The market then moved back to the 51,100 region, forming a psychological support zone between 51,000 and 51,100. Retail traders marked this zone as a key support area on the chart, believing that the market would bounce from this level. They anticipated a reversal and became active in placing long trades around it. Shortly afterward, the price broke through this support and dropped below the 51,000 level, forming a strong bearish candle. Now, The retail traders who had entered long positions earlier and suffered losses saw this breakdown as confirmation of further downside movement. Many fresh traders also joined in, opening short positions, as price action seemed to confirm a bearish setup, a false breakout followed by a clean breakdown below support with a large bearish candle. This pattern appeared to be an ideal short entry opportunity. However, within a short span, the market sharply reversed upward, trapping all the retail traders who had taken short trades. If you had combined the smart money concept with simple price action, you could have avoided falling into this trap. Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this November 1st. This isn't just another course, it's a complete system to master smart money concepts. Manage risk like a pro, and build consistency in your trades. And here's the crazy part. It's only $500, plus 61% off for pre-bookings before November 1st. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, secure your spot, and let's make this the turning point in your trading journey. See you inside. If you examine the chart's 15-minute time frame, you'll notice that the market has been in a steady downtrend, forming lower highs consistently. The seller liquidity remains visible near each swing high on the chart. Meanwhile, the buyer liquidity that had built up near each swing low has already been absorbed by the market. However, by the 4th, the liquidity belonging to buyers who entered expecting the market to rally is still active on the chart. This indicates that there's now more uncollected liquidity positioned near the upper levels than at the bottom. Since this upper liquidity hasn't yet been taken, the market on the 5th first sweeps the liquidity of buyers near the lower end, and then quickly targets and collects the liquidity of sellers positioned near the highs, moving sharply upward without much hesitation. If you pay close attention, the market essentially targeted external liquidity in both directions, first clearing the liquidity beneath the lows, then attacking the liquidity above the highs. This explains the appearance of large bullish candles on the chart. Many traders who entered short positions near the lower highs, seeing the ongoing downtrend, were forced to close their trades as the market surged upward. This wave of short covering increased buying pressure, causing a chain reaction that pushed the price up rapidly without any significant pullback. That's why, whenever you plan to enter a trade, you should analyze price action in combination with the smart money concept. Doing so helps you make better trading decisions and avoid common traps. When the price approaches a key level, attempts a breakout, and then reverses in the opposite direction, it creates a strong opportunity to enter a reversal trade with a small stop loss. This happens because when a large number of retail traders get trapped, it triggers panic in the market, leading to a powerful chain reaction and a sharp move in the same direction on the chart. For instance, on the 5th, the market consistently approached the psychological level of 24,000 and made several attempts to break above it but failed each time. Observing this, many retail traders entered short positions as soon as the market showed a bearish breakdown, since the price had repeatedly failed to surpass the 24,000 mark. It signaled the formation of a strong resistance zone on the chart, one that traders believed the market could not break through. As a result, retail traders began aggressively opening short positions around this level, which led to the buildup of significant liquidity on the upper side of the chart. After the market dipped slightly and then started to rise again, this psychological level triggered panic among retail traders. Once the market broke above it, those holding short positions rushed to close their trades. Because many traders acted simultaneously, a chain reaction occurred. This short covering increased buying pressure, driving the market upward continuously without much pause. If you analyze the chart, you'll notice that the price repeatedly tried to breach the 24,000 level, forming nearly identical highs, a pattern that could easily tempt traders into entering long positions. At the same time, if you apply the RSI indicator, you'll see that the price forms a flat line between 2 points. However, when the same line is drawn on the RSI, a bearish RSI divergence becomes visible. This divergence indicates that the market's momentum is weakening compared to the previous move, showing a mismatch between price action and indicator direction. A bearish RSI divergence is generally viewed as a warning signal, suggesting that even if a breakout occurs, it's likely to fail. Therefore, one should avoid entering long positions in such conditions. The more trade confirmations you have, the higher your chances of success. Hence, It's best to combine price action and smart money concepts with selective use of indicators. However, never rely solely on indicators for entry decisions. They should serve only as confirmation tools for your trade setup. That's it, traders. Thanks for watching this video. Discipline is the key that turns dreamers into achievers. If today's video gave you a new perspective or inspired you to take action, make sure to hit that like button. It really helps the channel grow. And if you're not part of the community yet, subscribe now and tap the notification bell so you never miss when the next strategy goes live. Keep learning, keep applying, and remember, every small step brings you closer to success. Thanks for watching, and I'll catch you in the next video.